Welcome to the Gray Report. I'm your host, Spencer Gray, and today we have a very special episode, a guest appearance. Chris Nebenzahl, Vice President of Rental Research at John Burns Research and Consulting. It's going to be an incredible episode diving into some of the short-term headwinds, but also some of the long-term opportunities in the rental space. A lot of incredible insights. So very excited for this interview. Let's not waste any more time. Let's get into it. All right, welcome back to the Gray Report. Chris Nebenzahl, Vice President of Rental Research at John Burns Research and Consulting. Chris, thank you for coming on the Gray Report today. How are you doing?
I'm doing great, Spencer. Thanks for having me. Really looking forward to our discussion.
Been really looking forward to having you on as well. It's incredible the amount of change that's taken place over the last couple of years, thinking about, pre-pandemic, during the pandemic, and, the aftershocks that we're going through right now. And so you're, I think, the perfect person to try to help us break down kind of, where we are and where we might be going. And that's what we've been doing here on the Gray Report really since 2020. As we found ourselves in the midst of an incredible amount of changes, trying to figure out what the next few months versus what the next couple of years are going to look like. And again, we're kind of at that inflection point of not sure where we're going to go. But first, before we get into that, Chris, you lead the apartment, build to rent, and single family rental, the products, as well as you develop the research, the company's research and public presence across various platforms and verticals at John Burns Research and Consulting. Can you tell us a little bit more about your role and what John Burns Research and Consulting, what do you guys do? What kind of research and consulting, what kind of products do you all produce?
So John Burns Research and Consulting, as the name implies, we're both a research and consulting firm. So we've got consultants, we've got market leaders all across the country who are diving in specifically on projects, on development, on adaptive reuse, on the for sale side, on the rental side, really helping clients build out their feasibility studies for specific sites and specific submarkets. Then on the research side, as you mentioned, I oversee the research for BTR and multifamily in our rental division. We really take a more macro view. So we're looking at things from the MSA level and above, looking at what markets are performing better than others, what metrics are really driving growth in BTR, in apartments, how are regions doing compared to one another, and what are the macro and demographic drivers supporting the housing industry. So the consultants really focus at the local level. The research team focuses at the MSA and national level, and we cover the whole housing industry. So again, the production home builders, we cover the rental market, we cover the resale market. We've got a great macro and demographics team that kind of tracks all sorts of different components of the economy and the demographic picture for housing. And we do that kind of across the housing market.
That's great. So if you're in the real estate business and you're looking to get some more insights on whether it's a particular market strategy or just a macro question, you all are a great source to be able to reach out to. And you produce some, I guess, reports that are put out for free, but then also some products that you need to subscribe to get access to those reports. Is that correct?
That's correct. Yeah. So our research is offered on a subscription model. We also have a quarterly public-facing webinar, and we put out a lot of newsletters, both on the for sale and for rent side, that are public-facing as well.
Awesome. Well, so if you're not familiar with John Burns Research and Consulting, I highly recommend you check them out. They put out some really good information. It's really some great research and insights. And then again, if you're in the development space, highly recommend get in touch with these guys. All right. Just before we hop into real estate and what you're seeing, you're also a skier and a golfer. We talked about a little bit before we started. So you have a goal of golfing or skiing in all 50 states. How are we on the process? Are we at all 50? Where are we in the journey?
We are not at all 50. That's a great question. I love talking about more of my hobbies and my passions. Where are we? We're probably at about 10 states skiing, I think. We might be a little bit higher on the golfing. I think we might be at 12 or 15. So long way to go. Knock on wood. I got plenty more years in front of me. But yeah, still very much a work in progress. I knocked off three more golfing states last year, and I think I knocked off one more skiing state. So plenty of
Nice.
runway in front of me.
There we go. Yeah, there's probably more golfing states than skiing states, I imagine. I know we're based in Indiana, so we don't exactly have all of the skiing opportunities I know you guys have out there in Colorado. But we do have decent golf courses. So, have you ever been to Indianapolis by chance?
I have been to Indianapolis a couple times. I have neither golfed nor skied, so that's on my list. And if I have to adjust it over time to make water skiing a viable option, I think that's a way to hit all 50 as well.
Well, if you come to Indy, let us know. Definitely get you on the golf course, but also we can probably figure out some water skiing. Probably not hit the slopes, but awesome. Okay, let's get into it. Chris, there's a lot of talk about sentiment out there today, investor sentiment, consumer sentiment. It's seen a stark decline, especially with all the macro and geopolitical discussions that have been happening. I'm curious if, from your standpoint, you're a housing economist. How do you feel? What's your sentiment? You're looking at the data. You're taking in empirical information. You're also just getting, some anecdotal tidbits here and there. Just curious, just your feelings on the rental market today.
Yeah, it's a great question. And thinking broadly from a macro level, you're absolutely right. Consumer sentiment has fallen. We're in incredibly volatile and uncertain times from the economy. And what I think that has done is really impacted the home buying market. If folks are a little bit more uncertain about their job or about their savings or about the economic situation at large, I think what we've seen is that it's impacted those who would be buying homes. And it's not the only thing impacting the home buying market. Certainly, elevated interest rates, high home prices, those are all factors that have slowed the home buying market for many Americans. Now, interestingly enough, that's actually pushed more folks to the rental market, or has actually kept people in the rental market for a little bit longer. We see in our research, we also hear from the apartment REITs that most folks, or oftentimes the main reason someone would be leaving an apartment or leaving the rental market is to buy a home. The apartment REITs continue to present record high retention.
Yep.
We've seen similar trends in our research that folks are staying in their apartments a little bit longer, and they're staying in BTR, they're staying in single family rentals longer. And a lot of that is just because of how unaffordable the housing market is on the for sale side. And so the headwind that is the economic uncertainty, the headwind that is the elevated cost of a mortgage and cost of home ownership, may actually be a tailwind for the rental market, for the apartment market, for the BTR market specifically.
That's what it certainly seems that way. I mean, it's never been more affordable to rent versus buying a single family home in terms of that spread between your rental payment and that mortgage payment. So not only do some individuals not want to make that big decision, big financial decision, but it's just not an option for many individuals, which is a really fascinating dynamic. Do you see much correlation? And I didn't think that there would be as much, but since the pandemic, I've kind of reversed course a little bit. I guess the correlation between rental demand, multifamily or single family rentals, and the for sale market. I thought that they would act pretty differently, but I've also seen in the past where kind of housing demand turns into housing demand either way. But it looks like this dynamic might be a little bit different. Do you have any thoughts on that?
Yeah, certainly. And I've heard the same thing, a rising tide floats all boats for the for sale market and the for rent market. Oftentimes, household formation is elevated, in stronger economic times when people are buying homes, when people are renting homes. And that's certainly true. What I would add to that, though, is that right now we see housing is still, a huge need for folks. Despite economic uncertainty, we're still seeing steady household formation. Uh, it's not to the level that we saw in 2021, but we're seeing steady household formation. And because the delta is so significant, the difference between home ownership and rentals is so significant, what we're seeing is that the rental market, again, single family rentals, BTR, multifamily, across the rental spectrum, they're really gaining the lion's share of that new household formation. So while household formation may not be as strong as it was a couple years ago, those households that are forming, in all likelihood, are forming and becoming rental households. Again, fewer and fewer households are moving from the rental market to the for sale market as well. So it's kind of keeping the demand for the rental market fairly robust.
Yeah.
But yeah, in typical kind of strong economies, you see both a good for sale and a for rent market. Right now, I think we're seeing a lot of the growth take place on the rental side.
Yeah, well, it does make sense, especially that again, it just may not be an option for many of those individuals that are looking to create that new household or looking to move out, and where in the past purchasing a home may have been an option, it may have been a reach, but it was still within the realm of possibility. But now, just that option just isn't there for um, many Americans, and those the categories of renters by choice versus renters by necessity. Those two cohorts have really kind of shift in terms of who makes that up. Is there's just not nearly as many renters by choice anymore. But also, the retention piece that you mentioned earlier, it makes a lot of sense because if you're uncertain about, the economy over the next 3 to 6 months, you're most likely not going to make a critical financial decision like moving, looking for a new apartment, or going out and buying a home, which is a huge financial decision. Um, so,
Spencer, I think you're right, and you mentioned kind of the renters by choice and the renters by necessity. Um, I think you're actually seeing more and more renters by choice and renters by necessity. When you look at kind of the demographic or the generational breakdown, you're seeing a lot of baby boomers who might be selling their homes and choosing to rent, choosing to relocate by their kids who might be having kids, choosing to say, you know what? I'm done mowing the lawn. I'm done shoveling the snow. I'm done maintaining my home. So there is some growth on that rental by choice category. To your point, the financial limitations of home buying is certainly keeping the rental by necessity category strong as well. But I think you've got kind of two factors at play driving demand for rentals.
it's a really good point. Just the growing idea that renting is a viable option. That it's not that um, owning a home is better than renting. I think that had been the mindset for the long period of time. The idea of pursuing the American dream and property ownership and home ownership. I think the conversation is a lot more nuanced today. I mean, just for example, as an anecdote, I mean, my sister-in-law owns a home. Owns a small home, is thinking about selling her home, moving to an apartment to save money to eventually buy a larger home, maybe in 5 years, but wants the flexibility of renting, likes the idea of having more amenities, and the fact that they're going to be saving money, banking it, investing in the stock market, so they can still grow wealth and be able to build a nest egg, but it doesn't necessarily have to be through the same traditional means that generations in the past have done it. So it's going to be interesting.
I think
Go
that's
ahead.
really interesting, especially when I look at the millennial generation, right? The millennial generation kind of coming out of the financial crisis. Maybe some of them were able to purchase homes in the 20 teens, but we've seen in the data the median age of a first-time home buyer continues to
Yeah.
get older and older and older. This generation seems to be a heavily renter generation. And one of the benefits, or many of the benefits, as you mentioned, the amenities, the lack of maintenance, it's easier to predict your costs, right? If you're a homeowner, you have to kind of keep some savings in case you need a new roof after a hailstorm, in case your boiler goes out. You don't have to worry about that as a renter. You can say, hey, I'll pocket some savings for travel, or I'll pocket some savings for, whatever other kind of lifestyle choice I make. Same thing with maintenance. I don't have to mow my lawn. I don't have to buy a lawnmower or commit an hour a week to doing that. A lot of people, I think, are saying, yeah, I don't mind the rental lifestyle. And I think the longer people stay renters, the less inclined they'll be to say, oh, yeah, I really want to jump into the home ownership market at 40, at 45, at 50. We don't have the data to totally prove that out, but I'm curious over the next really 5 to 10 years how that dynamic looks for a generation that has been mostly renters for quite a while now.
Do you think that with generation Gen Z coming up, now renting apartments, you hear the story that individuals in the Gen Z cohort and millennials, maybe some of the younger millennials, but grew up now never believing that they would ever actually be able to own a home, that was a kind of a dream of a previous generation. I'm a slightly older millennial, so it was always kind of part of the plan that I assumed that I would own a home one day. That's just kind of what the path of growing up, and you became an adult, and you got married, and you had kids, and you bought a house. Do you think just the mindset shift that I'm never going to be able to own a home also is starting to take some effect? That if you never planned for it, why would we think it'll ever happen?
Yeah, it's really interesting. And I know I just painted the millennials with a very broad brush. I hate painting generations with a broad brush like that because I think you'll see both in the Gen Zs and the millennials, there will be people that want to buy a home. There will be people that, whether they call it the American dream or whether they see, some of the tax benefits or the ways of growing wealth over time, like you mentioned, there will be interest in home ownership. On the flip side, there will be a lot of people who are renters for life, and I think kind of breaking the stereotype of you have to rent or you have to own. I think that will be a big trend or a big component in these two generations. I think there will be plenty of economic opportunity for people who own homes. There will be plenty of economic opportunity for people who rent as well. I don't think it has to be one way or the other. And so perhaps breaking down that broad brush stroke is a key component when we look at future generations and the demographics around them.
No, I think that makes a lot of sense. Shifting gears a little bit, just because it was just this week, meeting for the Federal Open Market Committee announced that not going to raise Fed funds rate. The rate has stayed unchanged. You made a comment on LinkedIn. Quote, the Fed will wait until they need to move, but when they do, they are prepared to move quickly. Later on, you said, I would not be surprised to see the Fed wait until the unemployment and economic data weaken significantly before stepping in with a large rate cut. When do you think we're going to start to see some of that hard data? I think we're kind of waiting for the shoe to drop, but what do you think the next couple of months might look like?
Yeah, I think the next couple of months will be pretty choppy. A couple reasons there. And thinking specifically about the employment numbers, immediately after Trump took the White House again in January, all the headlines were about Doge and job cuts and Elon Musk and what was going on in the federal government. A lot of those employees were furloughed, so they still are technically employed and not showing up in the unemployment data. So we haven't seen that impact yet. The April jobs report that was just released last week and was pretty strong, surprisingly
Yeah.
strong, beat a lot of economists' expectations. That was really taken, those numbers or that survey was taken, I think, the week after April 2nd. So the full impact of the tariffs and the wildly volatile April that we had might not have been seen. And a lot of those hiring decisions may actually have come from February and March when companies, were putting their hiring plans together even before the tariffs were announced. So a lot of that has yet to be fully baked into the employment data. I think you will see some up and down months. It wouldn't shock me to see some weak months on the employment side of things. Um, Volatility is probably a pretty reasonable bet in terms of the hard data over the next couple months. On the inflation side of things, the tariffs are on and then they're off, and then some of them are on and some of them are off, and some of them are high and some of them are low. Just this morning, I think we struck a deal with the UK.
Yeah.
Now they weren't, their tariffs weren't anywhere near what the Chinese tariffs were, and our imports and exports to the UK are not anything what they are with, Canada, Mexico, or China. But it seems like we may be making progress there. All of that's to say, there's going to be a lot of volatility and kind of shakeout to come. Um, Speaking specifically to monetary policy, if you look at Powell's press conference yesterday, and it wasn't just yesterday, he's kind of taken this approach through his entire leadership of the Federal Reserve. He's very patient. A lot of economists will say he's too patient, they wait too long. But if you look at what happened last September, folks were calling for rate cuts all through last year.
Yeah.
And then we finally got a rate cut in September, and they cut 50 basis points. And I don't think anyone was expecting they'd cut that much. So I think Powell and the current Fed, they're going to wait. They're going to wait. They're going to make sure the data is really, truly weakening and truly softening. And inflation is also not rising out of control because, again, they've got a dual mandate: price stability and employment stability or employment growth. I think they'll wait, but it wouldn't shock me if, if things really deteriorate, maybe we get another 50 basis point cut. Maybe we get kind of swifter action than a lot of folks were predicting. So yeah, I don't have a perfect crystal ball, but volatility over the next couple of months, and then hopefully we'll have some understanding on the federal government side, on the tariff side by kind of mid to late summer, and we can start kind of more stable growth from there.
Well, that seems to be the challenge. Is it's hard to kind of underwrite the rest of the year when we really don't know what policy is going to be and the effect of that policy to the macro economy. I mean, we saw negative GDP growth in the first quarter of the year, but we're still experiencing sticky inflation. Is a kind of a stagflationary environment close to your base case, or are we going to be seeing again some higher inflation but slower growth?
Yeah, I don't know if I would go all the way to the point of stagflation because inflation is still relatively in check. Again, we have yet to see the impact of the tariffs. We have yet to see inflation blow out yet. But I do see some economic softening, and we saw this before the tariffs. Really going back to kind of the tail end of last year, I wouldn't say we saw negative growth, but we certainly saw some softening. Now, the negative growth read, that's interesting. Really, it was an imbalance of imports and exports. From what I've heard, a lot of firms were kind of front running the tariffs, loading up on imports, getting their inventories high, and that might have led to the negative GDP growth. Negative GDP is negative GDP. You can cut GDP in 100,000 different ways
Yeah.
to kind of look at different sectors, but a negative read is a negative read. If we get another quarter, we're technically in a recession, right? I don't think it'll be a huge recession, and we may bounce back positive. Overall, I think we'll be at pretty flat GDP performance, pretty flat economic growth, um, with a risk of higher inflation. I don't see any opportunities, or I don't see inflation going much lower than where it is. There's certainly a risk that inflation goes higher. Again, on the jobs numbers, I don't see employment improving or unemployment falling. If anything, I see the unemployment rate increasing over the next couple of months.
I think that makes a lot of sense. It'd be hard to imagine just a reshuffling of the economy to not see some disruptions to employment. But I was shocked, as well as I think most of the street was last week when we saw that strong employment print on Friday. I think that took a lot of folks by surprise. And then you mentioned it, talk of recession. We did have technically a negative quarter of negative GDP growth. We also experienced something similar in I think back in 2023 we had two quarters of negative GDP growth, but it technically wasn't a recession. So it sounds like your base case is if we do find ourselves in a recession, could also be one of a maybe technical but not deep and a potential quick recovery, kind of outside of some other black swan event occurring.
Yeah, from an economic perspective, I think it'll be pretty steady. If we do see a technical recession, I would expect it'll be pretty light. Um, I don't know if we'll see a quick recovery. I think we might kind of bob around 0% growth, maybe
Yeah.
go negative, maybe go slightly positive, maybe go negative, maybe go slightly positive. But I don't see kind of a rapid recovery. Certainly with COVID, that was a black swan, once in a lifetime event, and you saw the sharp decline in GDP and then the sharp pop back. Even in the financial crisis, you saw a pretty sharp drop and then a steady and strong
Mhm.
recovery. I, I hesitate to use recovery because, are we even gonna go negative? Maybe yes, maybe no. Are we gonna bounce back? I see pretty flat growth either way, um, whether it's a decline or growth.
Yeah. I think this is all an exercise in really learning to be patient. I think that the market really, and especially in real estate, has wanted the market to kind of flush through the system, kind of get to that inflection point, and be able to move on. But just as so many things were brought forward during the pandemic and COVID, and we had multiple years of growth and activity within a single year. To me, sometimes it seems like we're now that it's stretching out and things are taking longer to progress. Certainly longer than we would want, and folks in the real estate industry would prefer to get back to what we would call a normal market. So next question is, related to monetary policy, interest rates, but then getting into real estate and cap rates in the market. Last summer there was a lot of talk about that multifamily cap rates had relatively normalized. There were some large, institutional transactions that took place, and the idea that really the market had kind of found its floor, and we'd be working our way back. A lot of that was predicated on the idea that we would see rate cuts throughout 2025, and we'd see lower inflation and lower interest rates. Given that we're not seeing lower rates, and again, inflation is a little bit stickier, and there's just even more uncertainty, in this higher for longer environment, can cap rates still remain relatively compressed and at a pretty historical tight spread to interest rate to cap rates? Do you see any changes there?
Yeah, I think where we're seeing the most change is between product types. I continue to see not a ton, but there are deals traded with, cap rates with high four handles. And
Yeah.
when you talk about the spread to treasury, I mean, that's less than 1%. It's hard to think that that could sustain itself. Now, those are pretty much exclusively Class A plus, best deal in the best market type cap rates. But that's a really, really tight window. There's negative leverage attached to those deals where they're borrowing. And the bet there is that we're going to see really, really strong rent growth. Maybe not this year, but next year, 2027, 2028, 2029. Um, I think the the factors that would lead to strong rent growth are starting to emerge. Supply is continues to come down. We're past peak supply in almost every market in the country. We continue to see strong absorption, and we see really strong absorption where we need to see it the most in markets like Austin and Dallas and Charlotte and Houston and Nashville. These markets have been talked about as some of the worst performing markets, Austin kind of being the poster child right there. But the absorption numbers are really, really strong. So even though they're not back to kind of even on the rent growth or their occupancy still trails the long-term average, the absorption is there, and we've seen the starts activity drop off significantly. Last year, even in 2023, very few projects are starting this year. So if that demand kind of stays where it is, I would expect to see a bounce back in those markets. Again, maybe not even this year, but certainly next year, 27, 28 are shaping up to be really strong growth years. And there are more and more headwinds emerging to supply. You mentioned high interest rates. It's really hard to get deals to pencil where interest rates are at right now. Then you've got a potential issue of construction costs. Now, a lot of firms, including the public REITs who reported recently, have said they're not seeing a massive impact from the tariffs yet, but a lot of that is due to subcontractors willing to compress margins a little bit because we're not building like we were a year ago when we had 600,000 starts a year. Now we're looking at probably 300,000. So when you cut the starts activity, when you cut the under construction activity, you've got all those subcontractors competing for work. They'll sharpen their pencils a little bit, but how long can they absorb the tariff impact if there are continued tariff impacts? And a lot of folks we're calling for somewhere between a 6 to 7% increase on the construction cost for materials. Now, obviously, with a development, you've got soft costs, you've got labor, et cetera. So it really translates to about a 2 to 3% increase on the whole project cost.
Hmm.
But subcontractors won't be able to eat that forever. And
Yeah.
so there are more and more kind of headwinds to supply, which tells me with lower supply and continued steady demand, especially in these Sunbelt markets, 26, 27, 28 will be decent to pretty good years. And that's where I think you're seeing a lot of the willingness of some of these firms to buy at negative leverage and with really tight cap rates. Now on the B and C class properties, there's been very little transaction activity because of where interest rates are, because of the situation that a lot of sellers don't want to acknowledge 5 or 6 cap rates. Um, when those deals start to trade, I think you're going to see a widening gap between the best of the best properties and some of those, 70s, 80s, 90s vintage product. Maybe there's a little bit more hair on the deal. Maybe the fundamentals aren't quite there. And a lot of these folks will be forced into selling. You know, when I think about when a lot of the transaction activity took place late 2020, 2021, 2022, well, we're coming up on 5 years from that
Yeah.
big boom. And when you think of, the 3+1+1 loan, well, that 5 year time frame is coming to an end. So there's going to have to be a recap. There's going to have to be a sale. Maybe some bridge or mezz debt comes in, but I think we're going to have to start seeing transaction activity, and I think you'll see higher cap rates on some of those B and C class deals.
I was just going to ask, what is that inflection point that allows that price discovery to take place across the class spectrum, but especially in those B and C class properties that we just haven't seen transact? Because you're right, I've seen some new Class A product in the Midwest even to trade for sub five caps, very recently, and it has to be you're speculating on the continued growth, strong demographics in that submarket, and some strong rent growth in later years. Still, the returns I think are a little bit skinny, but relatively safe markets. I can see how it makes sense. But to unlock the rest of the market, I'm glad you brought up the kind of some of the loans that have been maturing and are set to mature. There's also been a lot of loans that were set to mature last year and the year prior that were then extended. Now those maturity dates are at the end of this year, going through 2027. I believe right now there's about $582 billion worth of multifamily loans maturing between 2025 and 2027. And just recently read a report of that 56% of the multifamily debt has a DSCR below a 1.0, which means they're not producing enough cash flow to pay that existing mortgage. The New York Fed gave some guidance last year, encouraging lenders to kind of extend certain commercial real estate loans. That guidance seems to be shifted a little bit, but I'm curious of your take. Do banks allow this inflection point to occur over the next 2 years? Or do you see an attempt to really kind of smooth that wave or the curve to spread the maturities out further so it's less of one period of inflection and it's more of a rolling set of, I guess, price declines
Yeah,
or
I think
discovery?
I think the latter is more likely, that rolling set of price declines. I don't think the lenders want to kind of push owners to the brink, right?
Yeah.
With that being said, I think you will start to see a bit of a bifurcation in terms of whose loans get extended, who the banks and the lenders are willing to work with. One of the things we saw in 2020 and 2021, there were a lot of new entrants to the market, a lot of syndicators, a lot of folks gathering capital together that might not have decades of multifamily experience. Um, those owners, those borrowers might be the first that the lenders say, okay, you know what? I'm seeing weak DSCR. I'm not seeing the performance. Maybe we'll take this back, or maybe we'll put it into special servicing. The the firms that are better capitalized, have a longer reputation, longer history, those owners are more likely to kind of work things out, I think, with their lenders. Also, the larger the size of the group, um, the more diverse their portfolio, the more they'll be able to kind of spread things around. But I think some of the smaller players might get hit first.
Yeah.
And a lot of those players also did buy B and C class deals, that they could get their hands on to kind of start out their real estate portfolio in the past, 3, 4, 5 years. So I see kind of those opportunities for distress or opportunities for stress, if you want to call it that, emerging first. But I don't see the banks, taking back the keys in en masse. I
No.
think it'll be a slow progression, and it's also a race against time, right? A lot of those syndicators, a lot of those smaller players, if they can survive through this year, if they can survive into next year, and fundamental growth turns around, if you're an owner in Austin or Dallas or Nashville or parts of Florida, and you can say to your lender, hey, things are actually starting to turn the corner. Maybe you can work something out. But if fundamental performance stays weak, I think the lenders will be a little bit tighter. So I think it's really a race against time between what we're talking about with fundamental improvement and when those loans are coming due.
Yeah, no, there's definitely some owners that have some work to do, and some properties and assets that just, no matter of work or really interest rates are really going to help them out. There's just not enough time. I'm curious with, the stress, which I think is a better way to put it than distress, because it's certainly not across the board. It's relatively pocketed and at region, asset, and owner specific. Curious if you have any thoughts, though, on, I guess, the future of investment sentiment for multifamily. Multifamily has been a very popular investment vehicle over the last several years. With the rise, you said syndicators, crowdfunding. It's more popular for private wealth advisors. Does this, newfound stress, because multifamily had been considered a relatively safe and lower risk investment, do you believe that this new period of stress and folks are going to lose money? There's capital calls that are going on right now. Do you see that harboring, I guess, the longer term confidence for multifamily investment space?
Not really, actually. And maybe pockets of the investment space again, if you're a syndicator and you got your brother and your sister and your best friend and your doctor to pool money together and that deal didn't work out for you, yeah, you and all those investors might be, once bitten, twice shy and leave the market. Um, but I do think there will be, especially institutional activity, large capital interest in multifamily. You look at the other major asset classes, right? You look at retail in the 20 teens and no one wanted to touch retail, right? Because retail was dead and Amazon was taking over the world. You look at office through the COVID period. Well, office was once the, most ironclad investment, and that is or was no longer. Industrial had its moment in the sun, but now, with some of the trade tensions and discussions, maybe industrial is no longer as attractive as an asset class. And yet, housing is always going to be needed. Housing is always going to be there. To our point at the top of the podcast about home ownership and housing affordability, if those trends continue, multifamily only increases in value, in my opinion. And so I think there will always be investment appetite for multifamily. Again, it's one of those things that housing will always be needed, shelter will always be needed, and so there will always be interest. One other interesting component here on the short term, getting back to kind of the socio-geo-economic situation that we're in. I don't even know if that's the right term or if the right term has been coined yet. But I do think there is a little bit of skittishness or hesitation from some of the big foreign capital providers
Yeah.
investing in the US right now. So I don't know that that will last forever. I still think there's a lot of capital interested and a lot of domestic capital interested. But if we were looking for a potential headwind on the investment front, it might be that foreign direct investment is a little bit skittish right now in terms of U.S. real estate.
I think that was all really well said. I think so. Just to sum it up, some more on the retail side certainly could be some skittishness on the near term, but more the institutional investors, a little more clear picture on the long term. But also interesting on the international side, and it brings into this question of American exceptionalism and the United States being such an attractive market to invest in for all kinds of different equities, but especially real estate. Some of the strongest property rights in the world, but the United States is kind of fallen out of fashion in like the very short term. Do you think that it's going to be that short term and we just have to get through kind of this tariff volatility and the United States will kind of regain that position? Or do you have any longer term concerns about kind of that idea of American exceptionalism and the idea of foreign investors?
I think that's the $1 million, $1 billion, $1 trillion
Yeah,
question
yeah,
of the
trillion.
day, right? Here's what I'll say to that. 5, 6 short months ago, a lot of economists, a lot of investors were talking about the acronym TINA. There is no alternative. The US is such a strong economy, such a robust economy, their real estate market, their tech market. There's no alternative to investing in the US. Fast forward 6 months, and I don't know if we've found an alternative, but at least there's some hesitation. So the alternative might just be not investing at all, sitting on the sidelines. I say that in that things can change very rapidly, even on such a large scale as foreign direct investment. Um, I do think we're going through a bit of a challenging period to the way America is viewed internationally. Our economy, our our uh, our systems, the confidence that other countries may have in the United States, I think is certainly in question. Now, things can change quickly, but I think we will have our work cut out for us to rebuild that trust and rebuild that interest to an extent.
Yeah. Yeah, there's definitely going to be responsibility there. And it makes me think it can only go so long because I do think the United States has some unique properties that other areas of the world don't possess. But there's certainly that sentiment out there that there's interest in looking for an alternative to the United States. Whether countries find that alternative, I think is yet to be seen. But certainly just throws up in question some of the longer term, maybe being able to make forward progress. Switching away from just macro really quick because we're starting to run low on time. You're also covering the build to rent BTR space as well as the single family rental space. Build to rent BTR has been really fascinating, very fast growing segment of housing over the last 5-10 years or so. How's bring us up to speed? How has BTR been evolving in terms of the acceptance from larger investors, and I guess its prevalence as a portion of the market itself?
Yeah, I think the emergence of BTR as kind of a subsector of multifamily has really taken shape in the past 2 to 3 years with some of the institutional folks. The sector itself is, as you mentioned, more like 5 to 10 years old, but it's really taken off. Now, it has also gone through a similar supply boom to the way multifamily en masse apartments and BTR combined has gone through a supply boom. So fundamentals are a little bit soft. But I think if you go to an NMHC or one of the big apartment conferences, apartment events, a lot of people are talking about BTR. JP Morgan made their big announcement, I guess it was 2 or 3 months ago now, about their joint venture to get more into BTR. I think a lot of the big firms are looking at BTR. And I really see BTR as kind of this glue in between the single family rentals, the scattered site, the mom and pops, and the traditional multifamily. And really, you see kind of this spectrum of rental housing from a single family detached home all the way to your urban high rise. And BTR kind of fits that middle. It's got, the cottages, the horizontal apartments that might look and feel a little bit more like an apartment building. It's got the row homes and the townhomes that are getting a little bit less dense, but not quite, full single family. And then you've got the single family detached, which again, from the outside looking in, it looks and feels and sounds and smells exactly like a single family home. And so that's really kind of filling the gap. Again, thinking about what we were talking about at the beginning of the call, the position that homeownership and housing affordability is in right now, BTR is filling a lot of that gap as well. We talked about the aging millennials. Those folks are now to the point where, hey, I want to have a kid. I want to have a couple kids. I want to have a dog. I want to have a yard. Maybe they don't want to. Maybe they can't afford to purchase a home, but they don't want to stay in their mid-rise or high-rise or even garden apartment forever. Um, BTR is kind of a great opportunity for them. as is single family rental. But if they enjoy kind of the amenitized, the community feel
Yep.
that BTR provides, you're seeing a lot of folks go into BTR. Um, and again, on the flip side, those baby boomers who are retiring, maybe they're moving from the Midwest or the Northeast or California to be closer to their kids. Maybe they don't want to pull the trigger, even though they might be able to afford to purchase that home. The baby boom generation has a lot of the wealth that's being stored in the country right now. Maybe they could afford to purchase, but they say, again, for the same reasons, not to harp on it, don't want to mow the lawn, don't want to shovel the snow, don't want to have to deal with this. If I want to go away on a month-long vacation, walk out the door,
Yeah.
close it up, and not have to think about it. And BTR again is filling that segment. If those folks don't want to move into, an urban apartment or a garden apartment, they still want room for their kids to come over for dinner, to spend the weekend or whatever. So BTR is definitely filling that segment. As I mentioned, fundamentals are a little soft just with all the supply, but we see strong absorption. We see strong interest in the segment, both from investors and developers. Developers are facing the same challenges that multifamily developers are with construction costs and so forth. So I really see a reemergence and good fundamental growth for BTR over the next couple of years.
I think that the thesis makes an incredible amount of sense in the demand drivers and that sweet spot in between kind of a traditional apartment and a home, and there's just not as many traditional single family rentals out there as we probably need, and so it fits a really nice sweet spot. The question, as an operator that we have sometimes is, on the operation side, because it looks like multifamily, but it also seems a little bit different because the economies of scale are there, but at the same time, especially in single family detached, you've got the roofs times the amount of units versus at a multifamily property typically you've got maybe 20 units under one roof, and some of those others economies of scale. Do you feel like in your sense, I know this is a little maybe too micro, but have the operators found confidence that they've kind of figured out the operations in the BTR segment now that they've really been doing it for, again, 5 to 10 years, but really ramping up over the last 3 or so?
Yeah, I think you're starting to see, especially some of the bigger operators, some of the bigger names that you'd recognize, really kind of developing their strategy around BTR. But to your point, that single family detached or those townhomes a little bit more, because it is different. It is different from the bread and butter that they've done for years and decades in the past. One thing I note that I think a lot of the operators are taking into account are kind of the life cycle of a BTR renter. These units take a little bit longer than multifamily to lease up, especially
Mm-hmm.
the single family detached, but they also stay a lot longer. If you're moving, yourself or especially your family into a 2,000 square foot single family detached home, you're bringing everything that you've got with you. You're building out bedrooms and living rooms and everything. The likelihood that you're going to turn around 12 months later and say, okay, I'm done, I'm going to move out, that's a lot lower. When you've got a
Yeah.
studio apartment, you pack everything in a duffel bag and off you go to your
Yeah.
next
You're
apartment.
off.
You're seeing a lot lower turnover. And so, yeah, the risks are there. There are different expenses. There are higher expenses in certain areas. You talk about the roofs and the insurance and the maintenance. One of the things that we see is that on-site staffing and on-site maintenance is still a huge demand or a factor that's very much in
Mm.
demand at a lot of these BTR communities. Some are doing it with centralized management, but from the resident side, a lot of folks are saying, "Hey, I like having Bob or Jane, the maintenance
Yeah.
technician, right there if my sink breaks, if this happens, blah blah blah." So yeah, I think the operators are developing their strategy. I wouldn't say it's um, as ironclad as their history and their strategy with traditional multifamily, but certainly you're seeing a lot of operators figure this space out pretty quickly.
Yeah. Well, it seems so because, again, I see developers, investors. I mean, we've looked at several different projects. This is, again, the thesis of demand is really clear. And again, it's all about, do people really want that property or are they really looking for that experience and that the shift towards experiences in your lifestyle rather than the things in the stuff? And it's more important to have the backyard and the space for the family or for the dog than I just want to be able to own the title and the deed to a piece of property. So that I think that makes a lot of sense. Well, Chris, we're running out of time. What next can we expect from John Burns Research and Consulting? You guys working on anything exciting? And tell us a good way to get in touch with you or your team.
Yeah, it's kind of a good segue because we just finished a really in-depth analysis of BTR supply by product type. So our last quarterly report for rental communities focused on that BTR performance and supply by product type. We're looking at a lot of the absorption numbers right now. Hopefully, we'll have a lot of really interesting insights at the market level, at the national level with absorption. Just to kind of tease that out a little bit, as I mentioned, the absorption's been very, very strong in some of the markets that have been performing the weakest. So opportunities for a bounce back, opportunities for growth there. Interestingly enough, absorption has been pretty soft in a lot of the Midwest, a lot of California markets, but there's been such little supply, such limited supply that those markets are still performing the best. Indianapolis, where you are, and a lot of the Midwestern markets are seeing 3, 4, 5% rent growth. California markets are really recovering. I
Yep.
wouldn't say growing leaps and bounds, but positive rent growth is positive rent growth in this market, and a lot of the California markets are seeing positive rent growth. So an interesting kind of back and forth with absorption, with the demand, and then the supply side of things kind of balancing out or counterbalancing what's going on demand to lead to performance. But those are kind of top of mind for us. We put out a lot of good stuff on LinkedIn. Like I said, we do have a couple of public-facing webinars. We've got one coming up in June. We also have our client-exclusive webinars and our client-exclusive content. Please feel free to reach out to me or anyone on the John Burns team.
Awesome. Well, be sure to do that. If you are in the industry, whether in the development side, investing side, just definitely check out what John Burns Research and Consulting is doing and putting out there. Consider engaging them to get some more in-depth consulting. Check out some of their reports, or just follow the stuff what they're doing on LinkedIn. It's really, really interesting. Myself and the team definitely do. Well, Chris, thank you again for coming on the Gray Report. I'd love to have you back on some other time. Very, really good insights, a wide breadth of knowledge on what's going on in housing, multifamily, BTR, and single family rentals. So thanks again, and hope you come back on.
Thanks, Spencer. It's been my pleasure.
All right. Have a good one. Thank you.